Hello, everyone. Welcome to the first quarter 2025 market update by Tobias Financial Advisors. Thank you so much for spending your time with us today on this nice new 2025 year. And looking forward to talking about the market, the economy, what we see in 2025, what we have seen in 2024, and some planning updates as well. So we have a lot of different things to cover. We have a lot of slides to go over. But before we get started, within your, you should see a handout section. If you wanted to download these slides, it should be in that area. If you can't find it, please let us know and we can send them directly to you. And with that said, we'll get started. So before we get going, really, we have to list disclosures just to say that this webinar is an educational webinar. It's not investment advice. If you do need investment advice, please reach out to your investment advisor and your financial advisor. Today's presenters, I'm Chad NeSmith. I'm portfolio manager here at Tobias Financial. I've been here for about 4 years. I'm going to be going on 4 years in February, so I've got plenty of time now situating down from Georgia into Florida mode. I've spent many a times in Orlando at Disney World. I just went last weekend with my family. It was not busy at all, but all in all, Florida's great, and I like my role here at Tobias. I do trading and research. And so I manage portfolios behind the scenes, but I also do these quarterly webinars. And thanks so much for joining. I also have with me Christopher Brooks. He's a wealth planner here at Tobias. Christopher, how are you doing?
I'm doing well, Chad. Thank you for having me. For those of you who don't know me, I serve as a wealth planner on one of our advisory teams. So I'm day-to-day in client meetings and helping create plans. If anyone has any questions, feel free to reach out to me directly after the webinar as well.
Great. Sounds good. Thank you, Christopher. He's going to be covering the financial planning aspects later on in the presentation. So I really appreciate you coming on. And for those that work with him, he's obviously super great and you know him very well. But if you don't work with him, I love working with him. He's very knowledgeable and he's going to share some of that today. A little bit more about Tobias Financial Advisors. We're a registered investment advisor. We have a little bit over 850 million under management right now with over 300 households, 8 certified financial planners, and a 98% client retention rate. We're very active in our community. As you can see in the bottom right of the screen, we do corporate runs and we do charity events, very active in a lot of clubs and foundations within the area in South Florida. So, and we've been in business 44 years, so since 1980. I'm an 80s baby, but I'm towards the end in '89. This firm was around for a ways before I was even thought of. So been in business for a long time. Before we get into the actual market news and the economic news and what to think about portfolio and investing, just really want to lay the foundation and focus on what you can control. And I know yesterday was Inauguration Day. I was watching it and trying to pay attention to the news that was coming out of it and how the market was reacting to it. But at the end of the day, you have to focus on what you can control and focus on your portfolio, diversify broadly, reduce your expenses, minimize your taxes. Those are things that are within your wheelhouse, and you can work with your financial advisor to really hone in on those and improve your situation and your financial plan. All right, today's exciting agenda. Like I said, we have 30 slides, 30 plus slides, but we'll start out with the 2024 market review. Going into the fourth quarter market summary with historical performance going back dating 20 years now, and also getting the 2024 asset class returns where we talk about specific asset classes and how they did. Then I give a brief economic update. I'll talk about the jobs situation, employment situation, and interest rates. And then I'll talk about the market and market commentary and how the market has changed over time and over the decades. And then Christopher's going to hop in with some nice financial planning information. And then we're going to wrap it up with portfolio positioning, some things that we're optimistic about in 2025, some things we're a little cautious about, and then we'll answer any questions that you may have on your side. I think within your software, there may be a section where you can enter a question, and I'll be monitoring that and answer those at the end. But if we do not get to your question, before the end of the presentation, we will reach back out to you and we'll be in touch. All right, last quarter, 2024. This was a really big quarter. A lot shifted in the market, Remember, the election happened in November, and a lot of things changed basically on election day and the week of election day, and the few days after election. But the stock market was up 2.63% in the fourth quarter of 2024. International emerging stocks were down 7.43 and about 8%. And this was because of Donald Trump getting elected, and we saw a surge in the dollar, we saw a rise in interest rates, and we saw small caps do very well, and the domestic U.S. stock market rallied on that news. And global real estate turned over a good amount, down 9%, and that's because we saw interest rates move up, and real estate is an interest rate sensitive sector. U.S. bond market was down 3%. As you know, when interest rates rise, bond prices move down. So that put some pressure on bond prices and bond performance, but it really was a story about domestic stocks and small cap domestic stocks and kind of an America First message that is now within the current administration. And we saw him sign some tariffs, and some of the commentary out of tariffs are a little bit lighter than what the market was expecting, but there's going to be a lot of stuff to digest over the next couple of days with all of the executive orders that are coming in. We're going to back out a little bit and go a little bit longer term. So over the last year of 2024, the U.S. stock market was up 23, almost 24%. And international stocks were keeping up with them for the most part for most of the year until the election. And then they pulled back dramatically in the fourth quarter, and they wound up just a little bit less than 5% return on international stocks. That's Europe, that's Australia, and some of the more developed regions in the world, Canada. Emerging market stocks also lagged U.S. stocks, but did a little bit better internationally because China performed really well and India also did really well. We'll see that in the asset class breakout on the next slide. Global real estate eked out a small return of a little bit under 3%, and that was, I would say, good considering where interest rates started and where they ended up at the end of the year. U.S. bond market rates started out low, they rose throughout the year, so we did have a small positive return on the United States aggregate bond market, but global bonds about 5%, so they did a little bit better last year. Going back over 5 years, you can see we had the really rough 2022 within bonds, so it was still a negative return over the last 5 years in the bond market, and even going back the last 15, you just had a low interest rate environment. So bonds over the last 15 years are under 2.5%, and given where inflation's been, and knowing that this is a pre-tax return, bonds have been a pretty rough performer over the last 15 years. But the economy's changing, interest rates are rising, so going forward, we're expecting bond returns to be a lot more favorable over the next 15 years compared to the last 15 years. U.S. stock market was really the shining star over the last 10 or 15 years. A lot of it's driven by big tech that we'll talk about a little bit later in the presentation. And just technology has really taken over the domestic stock market in a way that we haven't seen before. But as you can see, over the last 15 years, 13.5% versus 5% on international stocks, and emerging markets of 3%. We're going to shift now to more asset class returns over the next slide. As you can see, there's a lot of green, a lot of spread out. Starts out really strong at 33% on the large cap Russell 1000 growth. So that's your Amazons, that's your Apples, NVIDIAs. Those really fast growing large tech companies are driving that, along with the NASDAQ. Gold really surprising, up 25%. I've noticed since gold has moved up, we've gotten some questions about gold from clients, and we've also seen a lot more gold commercials on TV. Christopher, are you seeing a lot of gold commercials on your side?
Absolutely, Chad. I find that I always see the gold commercials kind of after there's been the pop, and then it's substantiated for a little bit and plateaus frequently when everyone's buying into the commercials, but it's never before.
Yeah, the commercials are a lagging indicator, it seems, on gold. I remember starting out when I was early in the business in 2011. I was thinking, it was one of the bigger years for gold, and it was everywhere on TV. And I felt like every time a set of commercials come up, there was always one gold commercial, and we're seeing it come back. I think gold is good for protecting against inflation, but we do know historically bonds have outperformed gold, and we don't want to make it a major portion of the portfolio if we do want to implement it. But going down, S&P 500, 25%, that includes dividends. China, as we talked about earlier, China, almost 20% performance in China. So they implemented a lot of changes within their economy. They've been struggling with real estate, and it seems they've performed really well this year compared to last year. They were down pretty drastically that last year. India, another emerging market, doing really well. I just want to highlight that one, up 12% for the year. And then as we get lower down, we have Australia just eking out a little bit of a gain. US stocks, like I said earlier, up 1.25. And then we see some of these heavy export countries, Mexico and Brazil. These are heavy export countries that have not done well given the tariffs that have been implemented, or the threat of tariffs that have talked about with the Trump election. And those markets have pulled back pretty dramatically. So yeah, a broad stroke performance. This is a lot different than what we saw in 2022, when a lot of asset classes were down across the board, and 2023 when a lot of asset classes were up across the board. It's kind of a little bit more of a, I guess, a diversion of returns. So I think this is really interesting for the year of 2024. We're going to move on to talk a little bit more about the economy. This is a section I always love to talk about, and I know a lot of people love to get some nice insights on the economy. As you may know, that we've had really good jobs reports over the last 2 months, over 200,000 jobs added in the economy, and that's caused a lot of optimism domestically, because we're seeing a lot of people get jobs, and unemployment rates at 4.1%, and that's ahead of full unemployment, and it's been that way for a really long time, so it's really promising. But I think that this particular graph is the most important graph to me as I monitor our jobs domestically, and that's who's quitting jobs. And we're seeing a pickup in layoff, but we're really seeing a really fast fall off in quits. And if you can just tell the slope of this curve compared to even the 08, we've seen some past recessions. This is the dot-com bubble. It's kind of similar to that, like a fallout of a dot-com bubble. Not quite as drastic as what we saw in 2008, 2009, but we have positive GDP growth. However, less people feel good enough to quit their job because they're not finding new jobs. And a lot of the new jobs that are offered may have, a lot of people looking for jobs may want remote work, or they may want some benefits, maybe hybrid work or something like that. But we're seeing a less wage growth. And so all the people that were quitting during the Great Resignation, we're just not seeing the same thing. And it just keeps trending down. And this is just a sign that the job market is more in favor of the employer versus what we saw 3 years ago, more in favor of the employee. And so this is something I'm going to keep monitoring. And then maybe if we see this turn back, it may be more promising for workers and for consumption. But this is something that is going against what we're seeing in a lot of our other job data on the job growth and the hours worked growth and picking up over time, and participation rates. We're going to talk about on the next slide. This is just longer term, a couple of graphs that I've noticed that I think are really important to think about. On the left side, just about our labor force and the makeup of that labor force over time. As you can see, we have on the left side, we have grown our labor force and our population over time 1%. Part of it's been from births, net births, about 0.5%, but it's been trending down since 2007. A lot of people aren't really having as many kids as they used to, and immigration is taking up a larger percentage of our population growth. And then we saw a really strong uptick in immigration over the last couple of years, and CBO is projecting it to decrease with Trump taking office and to level off to about 0.25% a year net immigration, but it's going to offset some of our declining. We think we're going to have declining population starting in 2040. And so it's good that we're getting an immigration, because we're going to see a lot of other countries' populations decline over the next few decades. And so this is a longer term thought, not necessarily something that's going to happen in 2025, but just something we're monitoring. But I think on the right side, we see something really interesting with just the makeup of the labor force and the demographic shift that we've seen. This is just talking about ages. So this is females 25 to 54. This is males age 25 to 54. So this core working years. And then we have the 55 and over club. So those people, the 55 and over club, really dropped off for COVID. and they just haven't come back and participating in the job market. They're not looking for jobs. Maybe they're really having a hard time finding jobs, and females are really picking up the slack. The working age females are joining the labor force. They're looking for jobs, and this may be part of the reason that we're not seeing as much of a pickup in wage growth, because of 55 and over generally are higher paid because they have a lot of experience. And so maybe it's just that our labor force is becoming younger. And so we're getting more, less experienced workers on average, and that may be holding some of our wage growth down in the aggregate. So it's just something we're looking at that I find really interesting. We're going to shift away from the labor market and jobs, and we're going to go into interest rates. This is a slide I love to show. This is with the federal funds rate and short-term rate. So this is a nice approximation on what you may get in a high-yield savings account or in money markets. For much of 2024, we projected rates to move down, and we thought that by mid-25 we would see 3.5% in money market yields. But ever since Trump came into office and the recent jobs reports have come out, there's been a lot of optimism within interest rates. And so the market, this is the dark blue is what the Fed is saying, and this is a little bit dated. So the Fed needs to catch up to the market, but the market has shifted to where they think that the Fed's going to make one more cut in 2025 and then be done. And that's the end of the cutting cycle for the next several years. And so we're going to see, the market thinks that we're going to just see that 4% in short-term rates for a while. And that really caused something interesting happen with interest rates in general. Normally when the Fed is cutting rates, longer term rates like the 10-year tend to fall, and that's happened every time except for this one. And so that's why you may have heard people buying a house thinking when the Fed cuts, I'm going to be able to refinance my loan. But mortgages are more tied to the 10-year rate, and that rose this time. That was the only time in history that this rose. And so now it's something to consider, some of those people that may have bought houses over the last couple of years not being able to refinance. And how that's going to shake out in consumer spending and maybe the overreach, but that's something we're monitoring in the single family home and consumption in that real estate on the consumer side. But yeah, that's with interest rates. We're going to move on to the deficit and the federal government and the budget. So this is something that the deficit's been talked about ever since I've joined the industry in 2010, where we had a lot of government spending come out of 2008, 2009. And a lot of people were really worried about growing debt to GDP ratios and just the growing government debt. But a lot of that was hampered down by the low interest rate environment that we lived in. But with Trump coming in and possibly extending the Tax Cuts and Jobs Act, that's what this red is, plus higher interest rates, we're going to projected to run a pretty high deficit over the next several years because of these two things. So this is something that we hadn't experienced in the past because rates were so low. So we would have generally low spending, that's the gray bar, but then the blue bar are higher interest rates, and that interest rate outlay to pay the interest on the debt. So yeah, this is something that we may see. The market may get a little bit worried about the deficit growing if government spending isn't cut and cut dramatically, and just something long-term that may bubble up that we're monitoring within fixed income portfolios. So I think in the past it's been mentioned, but it's kind of not really taken flight. But this year it may start to take some flight, and it may be just some things that we're going to adjust in the portfolios, and just something to watch. We're going to talk a little bit about inflation. This is the slide that I have been showing every quarter since 2021. But they added some longer term years here, so I think that's really something new. So I had to throw it in. So, anyways, we saw 2% inflation, then obviously we spiked up to 9% in 2022. But I really just wanted to show this slide to just see the downward pressure we're seeing in some of the sections of inflation. So housing inflation, which is this dark blue line, it's consistently moving down, and we're seeing it in month-over-month data as well. So that's putting downward pressure on inflation. So even though tariffs may put upward pressure, it's really battling against this downward trend that we're seeing in housing and in auto insurance. Also, with the pickup in drilling for oil, we're probably going to see some lower energy prices domestically, which is going to help as well. So inflation's hard to predict, but I don't really see us getting up to the 9% anytime soon, given some of this downward pressure we're seeing in the economy and in prices. All right, we're halfway through our slides now. So I'm seeing 16 to 31. So I appreciate this. This is my favorite slide of the presentation. I think this is a really powerful slide to just think about the S&P 500 and those top 10 names and how the S&P has really shifted over the decades. So like I said earlier, I was born in 1989. In 1990, we had the top 10 holdings of the S&P were IBM, ExxonMobil, Philip Morris, General Electric, Philip Morris, the cigarette company, and Walmart, Coca-Cola, AT&T, these very mature companies back in 1990. And they were, I think, were very diverse in what they did. So Coca-Cola sells Coke, Walmart sells goods, it's a retailer, cigarettes, oil, a little bit of technology in there. And then in 2000, we had the technology bubble, and we see a little bit of Microsoft coming in, a little bit of Cisco coming in. But for the most part, the concentration, General Electric at 4%, was the highest concentration we saw in 2000. And then in 2010, ExxonMobil was the largest holding, but Apple was really starting to take off. Microsoft was starting to take off again. So we saw a little bit of technology in 2010. But as we can see, over the last 14 years, we're seeing a lot of concentration within the S&P, but also the businesses that make up this top 10 are overlapping businesses. So they're what's called correlated. And so Apple is competing against Microsoft, is competing against Google in different aspects. A lot of these companies are really tied to technology, and a lot of them move together. So we've had really strong performance in 23 and 24 in the domestic stock market, but a lot of this is due to the big growth in big tech that we're seeing. And the boring diversified S&P 500 that we've seen over the last 30 or 40 years isn't as boring and isn't as diversified as we've seen, as you can tell by this graph. So I think that's something to think about. Christopher, you have anything to say about this slide before we go, or
Absolutely. We're seeing with a lot of clients right now that are wanting to buy, especially NVIDIA or some of these individual stocks. And our response will always be, well, let's have a conversation about it. Of course, it's your funds, but we want to keep in mind, let's look at the trends. Let's look at the concentration, especially when we're looking at Apple, NVIDIA, Microsoft in the S&P 500. Will these companies go away? Probably not, but will they remain at the same level where they are? So when you look at it, can you predict what the next trend is, as opposed to owning the broader basket of funds, which is our generalized approach to take a diversified, portfolio for your retirement?
Great points. Yeah, and I think that these companies have gotten so big, $3 trillion. They're massive companies, so they're going to be a part of basically any portfolio at this point. That's a big reason we talk about international diversification, small cap diversification, just to maintain that equity exposure, but not necessarily tilt so heavily into a bunch of stocks that are highly correlated with each other. So talk a little bit more about the S&P 500. This is just something I've shown in the past in previous webinars, the concentration of those top 10 names. We saw that a little bit on the last slide, but you can just really see how it's grown over time. And really since 2016, it's taken off. On the right side, this is forward one-year returns with valuations of companies of the S&P 500. So this is what's called the price to earnings ratio. So for every dollar that's earned in the S&P 500, we're paying $21.3 per share. And that's the dollars that of earnings are expected to earn next year. But generally, as you move to the right, stocks get a little more expensive. And as you move to the left, stocks get a little bit cheaper. And it's not necessarily that we're predicting the returns, but what I do notice when I see this chart is just a whole of not very many 0 to 20% returns in this graph, in this section. A lot of the steadier returns happen when stocks are trading at more normal levels, more 14, 17, even maybe up to 18, 19 times earnings. But now we're at 21.3. We were just a little bit higher not too long ago. And so this can really introduce some volatility in portfolios where there may be a higher likelihood that we can get a higher return, and there may be a higher likelihood that we can get a negative return. We really don't know what it's going to be because it's only a single year, and we're long-term investors. But as stocks get more expensive, they also tend to get more volatile, and so it really is important to balance that out with broad international exposure like we do, with some emerging markets, and in the small cap space as well, just to really have a nice basket of stocks like we spoke about, and we continue to speak about. Now, the volatility here may worry you, but and also the political environment may worry you to some clients, but it is important to remember that time in the market is better than timing the market. And we really have to keep our politics out of our portfolio. And on the left side, this shows the growth of $100,000 invested over the last 10 years, depending on which party held the presidency. So if you only invested for Democrats, you doubled your money from 100K to 200,000. And if you only invested for Republicans and you stayed in cash for the rest of the time, you went from 100 to 181,000. But if you stayed invested, you were at 372. And this is a compounding effect that we see. So this is $1,000 invested over the last 70 years. So this is really where compound interest takes hold. You ended up with 31,000 for Republicans, 60,000 for Democrats, and then almost $1.9 million if you just stayed invested the entire time. And so this really speaks for staying the course and staying your plan and not trying to hop in and out the market depending on who's in power politically within the economy, because these companies are going to continue to make money. They're going to continue to have earnings, and the politics will always change. So with that, it is time for me to hand it off to Christopher. He's going to talk a little bit about financial planning in 2025. So thanks for coming in, Christopher.
Appreciate it, Chad. Yeah, I think the big goal here is that we just talked about the uncertainty and volatility in the market and how you can't time it. Let's discuss what we can control. One of the most important things, especially as we're in a new year, I know most of us have set New Year's resolutions. I don't know if you have, Chad.
Maybe to go to Disney more. I don't know. I think that I've owned a home for about a year now, so I really want to learn more home ownership skills of the pressure washing, some of the electrical work, some of the plumbing. So it's coming along just a little bit slow for me.
Absolutely. Well, I know that we're past what they're calling Quitters Friday, which I believe was about a week and a half ago, saying that's the day that most New Year's resolutions are done. But that's because a lot of them are far-fetched. We need to set manageable goals and really focus on them. And it's not all just fun goals that are short-term, such as more travel, maybe getting a vacation home, which can also translate into longer-term goals. But let's set our spending and saving goals. This will be really, really important to trying to make our financial plan work, as well as let's take care of our mental and physical well-being. Those are the only things we can really do to control the outcome of our retirement plans. So it's a great time. Schedule a call with your advisor. Let's work on the spending goal. Let's work on the saving goal and revisit where we're trying to build your plan to, as we're goal-based planners as opposed to trying to time the markets, like Chad said. So we're getting a lot of questions, and everyone, we're seeing in the news, a lot of people are fearful. We have a new administration coming in. First and foremost, I'd like to remind that this is not a new feeling. About every 4 to 8 years, this happens, and everyone gets nervous. So a lot of questions we're seeing are, will the economy stay as strong? Will tax laws change? And how will the new administration affect me? Unfortunately, the answer no one's gonna like, which is we can't tell you. But if there's any proposed regulations that you're seeing that you really think are impactful to you, schedule a time to speak with your advisor. We want to go through the nuances of it and say, how could this potentially positively or negatively affect you? But it's once again a really good time to let's work on the goals and remain committed to the longer term picture, as you're invested for much more than a 4-year political cycle. All right, so all of these goals, and then we're going to set, that are the longer term ones, as opposed to just I want to save X amount. or I want to work on my budget. How do we do that? The number one thing we can control within our financial plans is how much are we saving. So if you have yet to check off all of the boxes on your 2024 savings plan, there's a few that you can still make. We can still, up until April 15th, contribute to your Roth IRA, your traditional IRA, and your HSA for tax year 2024. So if you have any questions about that, about the eligibility, once again, please speak with your advisory team, as we have 2 more months effectively to guarantee that these are able to go in. And then we have new contribution limits for 2025 that we should be keeping in mind to help us achieve those goals. The IRA and Roth IRA limitations have remained the same. For those of us under 50 years old, we can contribute $7,000, and those over 50 years old, you're lucky and get that extra catch up. You're eligible to contribute $8,000. We have had a slight change, an increase of $500 per individual in the 401k, 403b, and 457 plans. So if you're under 50 years old, you're eligible to contribute $23,500 as the maximum. And if you're over 50, that number's gone up to 31,000. And then for the trifecta of tax savings, individuals on a high deductible health plan are eligible for $4,300 into an HSA plan, and the family plan is $8,550. And if you're over 55, you're eligible for a $1,000 catch-up.
A lot of ways to save for retirement this year.
Absolutely. And then for those who aren't satisfied, and this is a conversation that we're lucky to have with our clients regularly, which is, I want to try and defer more money towards my retirement in a tax beneficial way. So this is a new opportunity in 2025. It's called the Super Catch-Up. This is for savers who are or are turning age 60, 61, 62, and 63 in 2025. Unfortunately, you're not eligible if you turn 64 this year. So you're allowed to make an additional catch-up contribution in excess of the $7,500, let's say, for the 401k. It's the greater of $5,000 or 150% of the regular catch-up contribution. For example, for the 401k, this is an additional $3,750 on top of your catch-up for being 50 or older, which is $7,500. This makes your total contribution $34,750 that you're able to defer in tax year 2025. And then if you have a simple IRA, our recommendation is to speak with your advisor, as there are plan-specific nuances depending upon how many employees from your company are within your plan. Last but surely not least, we all need to have a New Year's checklist. I don't know about Chad, but I personally use my savings account a little bit extra at the holidays with extra travel and family gifts. So if you're like me, and sounds like Chad, this is a great time to make the goal to replenish your savings account if that took a little bit of a hit at the holidays. There's no shame to be felt there. As mentioned, let's meet with your advisors. Let's update the goals so that we can remain focused on the long term. If you are going to increase for the super catch up or even just the $500 extra limitation for many retirement plans, let's go in, update that contribution so we're not scrambling at year end and putting extra pressure on your wallet during holiday time. At the beginning of the year, I also like to remind my clients, go in, update and confirm your beneficiary designations or how you'd like them. I know that we're doing that in client meetings as well, but this is extremely important. And then last but not least, in light of the hurricanes in Florida this year, as well as the devastating fires out in California right now, it's always a good idea to review with your attorney and your advisors, your estate planning documents, and even your insurance coverage to make sure that both of them fit your needs and protect your family in the time of tragedy. As always, give us a call. We're also proactively reaching out for meetings, and during that we'll go discussing a lot of these items that we've mentioned here, but we are a resource for all of our clients and even your family and friends. If they have a question, have them contact us and we're happy to see however we can help.
Thanks, Christopher. That was really great. Yeah, it seems like every year my spending's on track, and then the holidays come around and it just because you want to buy somebody this gift, and then now, yeah, I'm sure a lot
It's
of people.
human nature. We're all guilty of it, unfortunately.
Yeah, the spending just picks up a little bit. But I'm gonna wrap up with a few slides on portfolio positioning, and then some optimistic and some cautious things to think about next year or this year. On fixed income, we're neutral on duration, so that's effectively the interest rate risk we're taking in portfolios. We're not really buying super short bonds, and we're not really buying super long-term bonds that mature in a long period of time. We're really sticking close to where the market is right now. But we are reviewing corporate versus government bonds due to the government spending that we talked about a little bit ago. Corporate bonds are not really yielding as much as they used to compared to treasury bonds, but it may be worthwhile considering some of that extra diversification if we do have some kind of a deficit scare later this year or next year. Within stocks, definitely maintaining our international exposure. Those companies are very attractively priced, and they also tilt away from that technology focus that we're seeing on the domestic side. And in small caps, really good diversifier right now. The top holding within small caps is I think the top 10 names of the small cap index are only 4% of that overall market compared to 38% that we saw. So a lot less top heavy. Those individual stocks do move a lot more, so they go up and down a lot more on an individual basis, but they aren't as correlated as the large cap stocks are. So they don't move in tandem with each other nearly as much. So it's a really good diversifier for the portfolio. On the opportunistic side, we did add the real estate last quarter, and that's real estate that doesn't include office space. We do think office and commercial, certain commercial is really going to struggle next year and this year as those rents kind of roll off. And we did just decrease our short-term treasury position, but with rates staying around 4%, we aren't as aggressive with decreasing that going forward because short-term rates are looking like they're going to stay in the low fours, like we talked about. Some things that we are optimistic about this year. We are seeing some artificial intelligence boosting worker productivity. I think Bank of America just released their AI assistant today within the bank, and we're seeing the productivity per worker starting to increase. Now, it's putting some pressure on the job market, but for consumers and for investors, it's going to be a net positive because we're going to have cheaper products and higher profits on both sides. It was really nice that we saw a ceasefire agreement in the Middle East, in Israel, between Israel and Gaza. We don't know the details of it, but we do know that they're working through potentially de-escalating that. And so that's really encouraging with the drastic increase we saw over the last couple of years with global tensions and geopolitical risk. So really great news, a reversal of the trend that we'd seen. And then consumer confidence. Ever since those prices peaked in 2022, it's been slowly trending upwards, and consumers are, I guess, maybe getting used to some of these higher prices. Right when they really moved in 22, there was a lot of sticker shock, especially at the pump, but it's been a slow move up that consumers are starting to be more confident and spend a little bit more. Some things that we're cautious about. We are seeing, like we talked about earlier, less people quit their jobs. So we're seeing more of the movement to the employer side versus the employee side of the job market. The Trump tariffs could cause a small economic shock because of our import prices changing very quickly. And then continuing government spending. It may cause market concern and something we're watching. I mentioned it a lot during this presentation, but I think it's something that's very important. But that's our last point of caution, and actually brings us to our last prepared slide. If there's any questions, I don't see any questions in the chat right now, but if there are any that come in, we'll definitely address them. And with that, Christopher, thank you so much for coming in and sharing about financial planning. Thank you everyone that's attended this. We really appreciate your time and very happy to share our thoughts on the market and the economy and what we see in portfolios going forward. So with that, I hope you have a great day, and we'll see you on the next one.
Thank you.
Thank you.